You're listening to Economics Detective Radio. My guest today is George Bragues. He is a professor of business at the University of Guelph-Humber. George, welcome to Economics Detective Radio.
Hi, thank you for having me.
So today our topic is going to be finance, and you are working on a project to develop an Austrian theory of finance. So I suppose the first question is, why isn't there an already existing Austrian theory of finance? I know there are people who use Austrian macroeconomics in finance, people like Peter Schiff or Mark Spitznagel. Is there no distinctly Austrian theory of finance?
That's a very good question as to why an Austrian theory of finance has not been fully constructed yet. There have been forays into the area. Certainly, people like Mark Skousen, Peter Boettke, and others have written on topics related to finance, but there's nothing really cohesive. There's no uniform theory. One can speculate why that is. It could be that the modern finance, insofar it has developed since its so-called Big Bang in 1952, when Harry Markowitz published his article in the Journal of Finance on portfolio selection, that modern finance is very quantitative. Austrians tend to be very skeptical, critical of mathematical approaches, and perhaps that has led them to shy away from the area. It could be as well that Austrians have been interested in other topics such as capital, entrepreneurship, and problems of knowledge, and have therefore found themselves so occupied in those areas that they haven't yet made a foray into the area of finance. All that being said, though, in the you mentioned two names there, Peter Schiff and Mark Spitznagel. In the more practitioner realm, Austrian economics has a definite influence in financial markets. There are prominent investors, traders, analysts who use Austrian methods, and specifically Austrian business cycle theory to guide their investments. But outside this practical realm, well, as I've already mentioned, there's been some theoretical work, nothing really sort of systematic, nothing that takes on the pillars, the main pillars of modern quantitative finance that MBA students and finance students and those who go on to Wall Street and Bay Street in the city are the concepts that they're educated under.
So some of the mainstream financial models that you're criticizing, they're things like CAPM and Black-Scholes and the efficient markets hypothesis.
Right.
They were all developed since this the Big Bang in 1952 you mentioned.
Yep.
What's the sort of, maybe you could take us through those and give us a little bit of the intellectual background there.
Right, sure. It's quite a long story, but I'll try to make it as brief as possible. But yeah, so that Big Bang, 1952, Harry Markowitz writes an article entitled "Portfolio Selection," and this is from this is spawned something called modern portfolio theory, or also known by the acronym MPT. And it is one of the five pillars of modern finance, arguably the foundational pillar of the entire enterprise. And what Markowitz did was provide a mathematical demonstration of an idea that was known beforehand, that you don't want to put all your eggs into one basket when investing, that there are benefits to diversifying one's portfolio. But what Markowitz did is provide a mathematical demonstration of those benefits. And he did so by providing a mathematical definition of risk. He defined risk as the variability of returns, meaning how much your returns can potentially vary over time. The more variance in those returns, the riskier the investment is. So that definition, which goes, by the way, against the sort of more common sense definition of risk, I think if you ask the person on the street or somebody working in the financial markets what they think of risk, they would define it as the chance of losing money, whereas Markowitz, perhaps to make it more mathematically tractable, essentially equated it with standard deviation. So using that notion of risk, and then combining that with returns, expected returns, in which these were defined as the probability of an event occurring multiplied by the value of that outcome, and then summing all the products. He was able to mathematically demonstrate that diversification has the benefit of reducing your risk without necessarily sacrificing expected returns. So that's number one. And one takeaway from modern portfolio theory is that modern finance has shifted the focus in investment analysis away from the analysis of individual securities, which is how traditionally investment analysis has been done on Wall Street and in the city and on Bay Street, and moved it towards the portfolio. That became the unit of analysis. And so modern portfolio theory tells us that to generate returns at a desired level of risk, don't pay too much attention to the specific securities that you happen to be contemplating on buying, but you want to look at how all those securities interact with each other. And Markowitz's idea is that as long as the securities, their expected returns are not expected to correlate perfectly with each other, you'll get a benefit of diversification. You'll be able to lower your risk and still get a desired level of return. After Markowitz, the field developed. You mentioned CAPM. CAPM is definitely one of the pillars of modern finance. CAPM basically argues that the return on a security is a function of two things. One is the risk-free rate. So when you buy a stock or a bond, you are at least going to get the risk-free rate. This is usually measured by the yield on some government security, usually the U.S. Treasury bond or a U.S. Treasury bill, depending on how long the security is, what the maturity of the security happens to be. And then the second factor that's supposed to drive returns, according to the capital asset pricing model, is something called market risk. This is the kind of risk that cannot be diversified away, according to modern portfolio theory. And market risk in the capital assets pricing model was equated to beta. And beta is essentially a security sensitivity to what is called the market portfolio, which is the portfolio of all securities in the world. But usually a proxy for that market portfolio is adopted by users of CAPM, and it's usually some sort of major stock index, such as the S&P 500 or something along those lines. So the thing with the capital assets pricing model is that the beta has shown to be a poor predictor of future returns. And this became well recognized by the 1990s. So a number of different models that are analogous to CAPM, but not exactly the same as CAPM have been developed. Probably the most well known is what's called the Fama French model, which argues that the return on a security is a function of not just the risk-free rate, but the price-to-book ratio of the security. and also the level of capitalization of the security. So, in other words, small cap stocks and stocks with high price to book value ratios, low price to book value ratios, are supposed to generate higher returns than stocks with low price to book ratios and stocks that are larger cap. So that's what's been happening there with CAPM. The efficient markets hypothesis is probably the best known of the 5 pillars of modern finance. This is the argument famously put forward by Eugene Fama in the 1960s and 1970s. Eugene Fama is a professor at the University of Chicago, and it argues that all information is already reflected. That is to say, all available information is already reflected in security prices. So there's no way to beat the market because whatever work you do to analyze the security, whether you analyze it fundamentally by looking up its financial reports, evaluating their management capabilities, assessing their place in the industry versus their competition, that information will already be in the price. But that too, just like CAPM, has come under assault. And the main driver of that assault is a burgeoning field called behavioral finance. Mm-hmm. This is an area that Robert Shiller, is most famously associated with. He won a Nobel Prize. I actually shared it with Eugene Fama a few years ago, and arguing that psychological factors need to be taken into consideration, and that there are certain cognitive biases. I won't go through all of them here, but there are certain cognitive biases that lead prices to deviate systematically away from where security should be given the information available. The remaining 2 pillars, one is Modigliani-Miller Theorem, M&M as it is known among aficionados. This theorem basically argues that the capital structure of a firm is irrelevant to its valuation. Traditionally, and still in many quarters, it is thought that the level of the proportion of debt versus equity that a firm uses to finance itself matters, that it will affect how it is valued in the marketplace. And it's associated with this belief is the view that higher debt firms should be discounted because higher debt firms involve higher risk because they're much more vulnerable to downturns in the economy or mistakes by management. And M&M argues that the value of the firm is completely based on the discounted value of its future cash flows. It has nothing to do with how it happens to be financed. The final pillar, the final of the 5, is Black-Scholes option pricing model. And this is some wicked math goes into this one. But basically, it is a model developed in, I think it was 1973. I think it was an article, I think it was published in the Journal of Political Economy, if my memory serves me correctly. And it provides a mode of pricing options. Options are the right to buy or sell a security at a price that you set now. And you have this right to do so up until some defined period in time in the future. They came up with a model for this. The wider significance of this model is that the mathematics, the concepts used in this model, have been replicated in a wide array of other derivative securities, such as credit default swaps and collateralized debt obligations. A lot of these instruments that came to the fore in the recent financial crisis. And so those are the major 5 pillars. And so what I try to do is I'm trying to determine what is the Austrian take on these 5 pillars with a view to ultimately developing some form of Austrian theory of finance.
I have a bit of an anecdote about Black-Scholes. I was a first-year undergrad studying econ in 2008 when the crisis happened, and the first I ever heard of Black-Scholes was someone saying that Black-Scholes was responsible for the financial crisis.
Yes.
Got a bit of a bad reputation there.
Yeah. So perhaps they read Nassim Taleb, who's been very famous in criticizing Black-Scholes. One of the main problem with Black-Scholes, and I think something that from an Austrian point of view is correct, is that the model assumes a certain distribution of returns in the future. In order to price an option, in order to price the right to buy or sell something at a figure that you set now, and then this right will extend over some defined period of time, you have to have some way of forecasting what the underlying security is likely to do during that predefined period of time. And so the way the Black-Scholes model deals with that problem is it assumes a normal distribution of returns, otherwise known as the bell curve. And so it assumes that the current state is the one that's most likely to be the case going forward, and that deviations from the current situation are equally probable, whether to the upside or to the downside. But the reality is that certainly we saw this with the 1987 market crash. We saw this with 2008. We saw this as well in 2000 when the dot-com boom went into bust, that negative returns, indeed large negative returns, are much more likely than predicted by normal distribution, and also that negative returns occur far more often than one would expect than positive returns. So you don't get a bell curve. You get something. You get skews, and the skews tend to be tilted towards the negative end of the return spectrum. So Nassim Taleb, who wrote a book called The Black Swan, calls these events, these negative skews, black swan events, things that cannot be predicted. And so that's the problem with the Black-Scholes, is that it leads you to price the security on the assumption that negative events are not all that likely to occur. And when they do occur, then whoever is holding the securities, usually major financial institutions, end up in financial straits.
It seems like there's a conflict with Mises' idea that risk is essentially unquantifiable. Right.
Yeah, it's a very good point that you raise, and one that I'm still thinking about. In Human Action, Mises has a very interesting discussion of risk, and he discusses two types of risk. And there's one type of risk that insurance companies are subject to, which is fairly predictable. You're deciding to insure a neighborhood, all the houses in the neighborhood against fire. You look back in history, you find out, for example, there's in any given year, you'll typically have 1 to 2 houses in a neighborhood on fire. So let's say it's 1 in 100 shot. And therefore, you could price your insurance premiums reflecting that, and you're good to go in terms of managing your risk. But there are other types of situation where the history is not so clear cut, where the events in the past that you're looking at to try to gauge what might happen in the future are very different from what is likely to transpire in the future. In other words, you're always confronted with unique events. You're not dealing with a situation like dice throwing, where the event that you're trying to predict is fairly similar in the key features in the past to what you're trying to predict going forward. And so in that sense, there's no way to mathematize it. Like with dice, you could say, okay, the odds of a 1 showing when a die is rolled is 1 in 6. How do we know that? Well, historically, that's you keep on throwing ones over 1 billion throws. They'll tend to show up 1 in 6 times. And as we go forward, the event that we're trying to predict is fundamentally similar in its essentials to dice throws in the past. But when you're dealing with stock markets, bonds and currencies, and all the rest of the financial universe, you're dealing with situations in which what you're trying to predict, even though there's past data to look at, the factors that cause things in the past are always going to be different than the factors that will cause things in the future. So therefore, you can't use history as a reliable guide to predict what's going to happen in the future. Therefore, any mathematical methods are therefore useless. So my thinking at this point, although as I said before, I'm still reflecting on this as I'm completing an initial paper for conference proceedings at the Mises Canada held recently, is that my initial thinking is that the Austrians, from an Austrian point of view, coming up with an option pricing model is utterly hopeless, because there's no way that you can come up with any mathematical vision of the future that you would need in order to support such a model.
Well, it certainly wouldn't fit into what Mises would call theory, but it would certainly, entrepreneurs must have some sort of quantitative idea or guess as to what will happen.
Yeah. It offered me a good segue in terms of, what would be the Austrian alternative in terms of pricing options? Because somebody who works in this area might say, I get what you're saying, Austrians, that we can't predict the future and we can't mathematically render tractable any notion of the future, but I need to still trade options. And I still need to give a price to my customers when they call in and they want to buy calls or puts or swaps. So the Austrian answer to that is what you're saying, is that you need practice, you need prudence. Mises refers to this in his sort of German way here, understanding. You need an attunement to particular circumstances. You need to have a kind of practical savvy that is gained from experience. And so that you could use that to figure out what the price of an option should be, at least some range. You should be able to get a sense that the option price in a particular circumstance may be a little too high or a little too low or just about right. But there's no hard and fast mathematical method. There is a method honed by experience. It will involve numbers, but it will involve numbers in a way that you always see them as a kind of guide rather than as something providing real precise point estimates.
And it seems like with Black-Scholes assuming the distribution of future returns, that they're really like assuming away the most interesting question, which is, if we're what is the economy going to do? If we maybe think about all sorts of they're assuming away basically all of macroeconomics.
Right, yeah. I mean, the idea that things can be assumed to fall into a normal distribution does ignore one of the findings of Austrian macro, which is that the government is involved in macroeconomic policy, and to the extent that it becomes involved, it systematically biases things towards unstable states. And states in which black swan events are more likely. So, I think from an Austrian standpoint, the idea of a normal distribution being our vision of the future runs against the awareness that you've got governments meddling in the economy, trying to manage aggregate demand. You've got governments with their central bank arms trying to influence interest rates in a preferred direction. You've got governments who are systematically biased towards having lower interest rates than what the market would otherwise dictate, and this creates these bubble bust sequences, which create while you can know that they're coming up, you can never know exactly when certain key events will transpire. You can never really know the magnitude of when of a bust. You sort of just have a hazy idea that's coming up, but clear. Though it's hazy, it's still clear enough to recognize that normal distribution as your model of the future is certainly not viable.
And well, we'll use that as a segue to talk a little bit about the efficient markets hypothesis, which of course has been used as a criticism of Austrian business cycle theory.
Mm-hmm. So the efficient markets hypothesis, is, as I already mentioned, is the view that all information is already in the price. Now, this is the one area of contemporary finance where Austrians haven't, in fact, said quite a bit, and so this is I would summarize the commentary as follows: one, the Austrian view of EMH is the acronym for efficient markets hypothesis commonly used, is that EMH goes awry in the same way that neoclassical economics, the orthodoxy, goes awry in assuming that equilibrium is the normal state of affairs. Because the efficient markets hypothesis assumes equilibrium is reached instantaneously, that pretty much at any moment the market is open, and for most securities that are traded there, we have an equilibrium condition. The AMH proponents do concede that there are moments of disequilibrium, but that they're so short, literally milliseconds in some cases now with high-frequency trading, that for all practical purposes, from the point of view of a portfolio manager or an ordinary investor, the price that you see right now is the equilibrium price. So that goes against Austrian economics. Austrian economics does not view equilibrium as a normal condition. It views equilibrium actually as abnormal. Equilibrium is something that is a force to be reckoned with. Markets are always tending towards equilibrium in the Austrian point of view, but never quite getting there. And so, in the Austrian point of view, this is where the entrepreneurial function comes in. Entrepreneurs, their role in economic life is to identify misequilibriums that are occurring before everyone else does, and a misequilibrium being a situation where the resources to produce a good or service are at that point in time obtainable at a cheaper rate than you could after producing the good or service that you could subsequently sell them at. So entrepreneurs are always looking for this opportunity, and this is no exception in the financial markets. So from an Austrian point of view, markets are usually in a state of disequilibrium. There are entrepreneurs, otherwise in the financial markets, these are known as traders and research analysts and hedge fund managers and portfolio managers in general, and their task is to find these disequilibrium opportunities to generate better than market, better than average rate of returns. This is not to say that from the Austrian point of view, generating these above average returns is easy. Successful entrepreneurs are a rare breed. It takes a lot of prudential understanding, a lot of courage to be able to identify and then exploit these opportunities. But these people are out there, and so that would be the Austrian explanation for the Warren Buffetts of the world. From an EMH point of view, Warren Buffett is merely lucky. That the only reason he's been able to do better than the vast majority of other investors is that he's just sort of won a lottery over and over again. But there's no skill there. From an Austrian point of view, Warren Buffett testifies to entrepreneurial skill.
Him winning a lottery over and over is possible, but implausible.
Yes. I would agree with that.
The other model we haven't gone through your critique of is CAPM. There's I believe you had some issues with the idea of a risk-free rate
That's right. To summarize again what CAPM is all about, CAPM basically tries to depict what the factors are that drive the rate of return on a security. It identifies two: the risk-free rate and the market and the market rate of return. So the risk-free rate, this is from an Austrian point of view, there is actually no such thing as a risk-free anything. Risk is inherent to human affairs. Anytime you act, you act amid uncertainty. Indeed, from an Austrian point, the very fact that you act implies uncertainty, because if you knew what was coming, there'd be no point in acting, because what was coming would be inevitable. The rational approach then to existence would be a passive approach. But the fact that we act, that we try to improve our condition from its current state to a better future state, implies uncertainty. It implies the chance that we will not actually get what we want. And so because risk is inherent to human existence, there is no exception to this. There is no place in the bond market, even in the government bond market, and even among the most seemingly secure governments, even amongst the United States government, which, as I said before, their bonds are taken as the standard for the risk-free rate. In Europe, it's Germany, the German Bund, because anything can happen. It's admittedly not as likely to happen to the United States as it would be to, say, Portugal or Greece or Italy or Venezuela, countries that are widely perceived to pose higher risk on their bonds. But it can happen, and so there's no risk-free rate. So the Austrian view is that what you get compensated for when you're abstracting, when you're separating market risk, is you're getting compensated for time, for essentially denying yourself consumption now, and instead deciding to wait to consume in the future. So that is the rate at which that happens is known as the time discount rate. So really, if you're going to figure out what the rate of a return on a security is a function of, instead of looking at the risk-free rate, you need to look at the time discount rate. And as I also pointed out in my presentation at the Mises Canada at the conference that they held back in November, is that this time discount rate is actually very hard to pin down, which creates further difficulties for any equation along the lines of CAPM. When you're taught CAPM in school, you are immediately when you're trying to figure out what you put into that for that risk-free rate variable, you consult the 10-year bond yield on U.S. government bonds. But try to do that with a time discount rate, you're not going to be able to find it so easily because of central bank interference in the bond and money markets. Because central banks intervene actively in the bond and money markets through their open market operations, we can never really be sure what the time discount rate is in the marketplace. If the prevailing rate on 10-year bonds is 2%, that may not be the time discount rate. That could just be the rate that the central bank has managed to place the bonds at. So operationalizing any model is difficult for this reason.
So the time discount rate is a subjective preference on the part of consumers?
That's right, yeah. So it'd be the overall time discount rate would be a kind of average. Everybody has a different one. Some people are only willing to forsake present consumption at the rate of 5%. That is to say, if they're compensated 5% down the line. Some people at 7%, some people it's 2%. But the time discount rate in the market would be the average of everybody's individual rates.
Well, this really old school Austrian. I was reading Bombaverk's Capital and Interest earlier this year.
Yeah,
and of course he sort of debunked. There were all sorts of theories of what determines the interest rate, and he sort of went through and debunked them and pushed his own discount rate theory. But is CAPM then, is it sort of another theory that has arisen since then of essentially interest rates, or?
No, I wouldn't construe it that way. I mean, it might potentially be interpreted in that fashion, but I think CAPM tries to abstract from those debates and just come up with a tractable model. Has adopted the risk-free rate to explain the return on a security that risk can otherwise explain. So the risk-return rate is CAPM's way of dealing with time. But I think they go awry in assuming that is actually risk-free when they're looking at the at government bond yields.
Risk-free rate we might think of as, is it what the interest rate would be if there were no, in a purely free market, or in at least in a market in equilibrium?
Yes, that's right. Yeah, it would be the natural rate of interest, to use Wixell's terminology. It would be the rate that if supply and demand for loanable funds were allowed to operate freely of central bank intervention, that would be the rate. I mean, if such a market existed, then we would know what the time discount rate is, and that, yeah, to that extent, a model along the lines of CAPM would be tractable, at least in its risk-free component.
So, as you continue to work on this project, how do you see it going? Do you see finance practitioners having a lot of use for an Austrian theory of finance?
I think so. I think for a number of reasons. One, I think practitioners currently have a love-hate relationship with modern quantitative finance. I think there's a certain respect for modern quantitative finance out on Wall Street because of the mathematical architecture with which it is surrounded. So it has a very impressive kind of edifice, and don't get me wrong, I think modern quantitative finance has some utility. I think it does provide a reasonable, though not perfect, foundation for understanding why diversification is a good thing to do when investing. I think too, its mathematical approach at least sort of disciplines you as an investor, as a portfolio manager, and allows one to avoid the biases that do come from taking a more discretionary approach, where you become much more vulnerable to emotions. So I think for those reasons, the modern quantitative finance has its fans on Wall Street. I think too, also a lot of people on Wall Street today have been educated under these principles, and so there's a way in which these things tend to carry on as a result. But I think too, among financial market practitioners, there is a sense that these tools are quite limited. I think that sense is certainly magnified since the financial crisis, and so that makes them open to alternative points of view, in which points of view such as the Austrian view, in which the mathematical components of orthodox finance are questioned, and in which the entrepreneurial element, the prudential element, the practical savvy element, the experience element come more to the fore. I think too, if you look at how Austrian economics has been practically used in the markets, the component that is most used is the business cycle theory. That theory, certainly since 2008, has actually become much more prominent even outside Austrian economics, and has almost, I stress the word almost, but has almost sort of become part of the mainstream thinking among financial market practitioners. There is an awareness among those who make their living on Wall Street that the Fed matters. The Fed matters a great deal. It's always been out there. It's not like prior to 2008, people didn't know that the Fed mattered. There's long been a saying among market professionals, don't fight the Fed. But that saying has gained new resonance since 2008, since quantitative easing, since people have become aware of the damage that an overly easy monetary policy can do. I think now it's pretty much the consensus view on Wall Street that the Fed was too easy prior to 2008, and that did much to cause the subsequent maelstrom. And then there's also been a growing awareness of how the Fed drives stock prices, because investors increasingly notice that the ups and downs of the S&P 500 correspond quite closely with Fed policy, so I think even though if you go to your typical portfolio manager, they might vaguely be aware of Mises or Hayek, they would have perhaps some sense of Austrian business cycle theory. They may have read about it in the Wall Street Journal or the Economist magazine, but yet as a practical matter, they seem to be acting as if they believe it. And I think that bodes well for the potential of an Austrian theory of finance gaining traction in the markets.
And I suppose there's just one last theory to compare Austrian theory to, and that would be behavioral finance. Do you
That's
see
right.
an Austrian theory of finance as sort of falling between behavioral and the more traditional models?
Yes. Behavioral finance, if EMH goes too far in stressing the rationality of investors, behavioral finance, I would argue, goes too far in emphasizing the lack of rationality or the emotionality of investors. Because when you read the behavioral finance literature, one thing that strikes you is just the number of biases that they have identified, some of them contradicting each other. My favorite example of this is the clustering illusion versus the Gamblers Fallacy. These are both biases that the literature of behavioral finance have identified as affecting investors, but they provide a convenient way for behavioral finance to explain anything. And the way it works would be as follows. Let's say Gamblers Fallacy is the fallacy that a trend, that if there's something repeated, that it is likely to reverse. So it's known as the Gamblers Fallacy because you see it in casinos where somebody might be at the roulette table. They notice that red has come up, say, 6 times in a row, and they therefore believe that on the next spin of the table, black is likely to come up. The reality is that the probabilities of black versus red do not change, assuming that the table is not biased, do not change from one roll to the next. So the clustering illusion is the opposite. The clustering illusion is the belief that if things are moving in a certain direction, that they're likely to continue in that direction. And so you've got two biases, but they each of them can be used to interpret an event. So if, for example, let's say you have a situation where the market is continually going in the same direction, and so the trend is it's sort of people just sort of following each other, buying because everybody else is buying.
People used to say, buy real estate, it always goes up.
That's right, yeah. So you could say, behavioral finance could say, oh, well, that's the clustering illusion in operation. Okay, fine. Now, if you have a situation, though, where something's been going up and then people are betting against it, behavioral finance can say, well, that's the Gambler's Fallacy in operation. So it's part of good science that if a theory has to be in principle refutable, but to the extent that behavioral finance has got these opposing biases, in one case, the same set of circumstances can explain a downward move in price. In another, the other bias can use the same movement in prices to explain a continued up movement. You've got a theory that is essentially irrefutable. So So in terms of the Austrian take, strictly speaking, Austrian economics is opposed to the use of psychology in economics. Austrian economics tries to minimize as much as possible the use of psychological assumptions. The only psychological assumption, if you want to call it a psychological assumption, is the assumption that human beings act, meaning that they're always constantly endeavoring to improve their situation, and then they try to choose the appropriate means to do so, to reach their subjectively chosen ends. That's it. That's pretty much all the psychology that Austrian economics believes is necessary to do good economics. Austrian economics then argues that you can deduce economic theory from that core assumption of human action. Once you start bringing in biases like the Gamblers Fallacy that I've already mentioned, or the clustering illusion, there are a number of others. There's the recency bias, the halo bias, the conservatism bias. Once you're doing that, you're no longer doing economics. According to the Austrian view, you're doing more something along the lines of economic history. And in economic history, what you're doing is you're looking at actual facts, empirical data, and you're applying theory to that data. So Austrian economics has no necessary qualm with behavioral economics if it's part of an exercise in economic history. If, say, in trying to account for a previous boom, if, say, in trying to account for what happened in 2008, I don't think it'd be an issue using some of those psychological categories, as long as they fit the data that you're trying to explain. Mises talks about this in a book called Theory and History. He actually refers to this. He has a term called themology for this kind of analysis, where you're bringing in psychological categories to explain things that happened in the past, but you're not really doing economics per se. So it's kind of complicated to neatly summarize what the Austrian take would be on behavioral finance. But I guess if I were to do so, it'd be as follows: A, behavioral finance, strictly speaking, is not economics. B, behavioral finance can be potentially helpful in doing economic history.
And in Austrian theory, there's a focus on profit and loss as a sort of selection mechanism between different entrepreneurs. So to the extent that people have these biases, if they cause them to lose money, then they're going to be filtered out. They're going to have lesser effect over time.
That's right, yeah. I think this is, in the long run, people who are systematically biased in their as they engage in the entrepreneurial task of trying to forecast future demand, in trying to forecast prices effectively, they will be weeded out. I think the difference between the Austrian view and EMH on this is that EMH thinks that this weeding out process is much more instantaneous than the Austrians would take it. So the Austrian view, there is an economist, people don't know him these days, his name is Lucian Albert Hahn, and I've written a paper on his discussion of the stock market. It was published in the Quarterly Journal of Austrian Economics a few years ago. And Hahn was a banker. At one point, he was also an academic, but spent most of his career as a banker, very influenced by Austrian economic ideas. Wrote a book called Common Sense Economics. And it's the final chapter where he discusses the stock market, and he gives a fairly Austrian view of how markets work. And his argument is that he sort of tries to forge a kind of third way between behavioral finance and EMH, which I think is where Austrian economics ultimately needs to go when it eventually develops a cohesive view on these matters. And Hahn's argument is that markets are ultimately efficient, but only over the longer haul. And yes, over this longer haul, those people who are systematically biased do get set aside in the market process.
Do you have any final thoughts? Anything we didn't cover?
I think we covered it all here. I think I would say I would sum up the tentative conclusions I've been able to reach at this point as follows. I would say that the Austrian view would be that the return on a security is a function not of the risk-free rate plus the market rate, but rather the time discount rate plus the compensation that for entrepreneurial risk that is inevitably assumed when investing. I would also, as I see it right now, I see a potential Austrian markets hypothesis eventually coming out of this, and the Austrian markets hypothesis would be that market prices are constantly endeavoring, but never actually succeeding to assimilate all relevant information. And then we didn't have too much of a chance to talk about Modigliani-Miller. It's more of a corporate finance thing rather than investment finance. But I would think that where I'm tending to think here is that the Austrians would find major problems with M&M, and Austrians would argue that corporate in corporate finance, the way a firm is financed does matter. That firms are ultimately engaged in the entrepreneurial task of forecasting future demand. To the extent that one has more debt on one's balance sheet than equity, the firm becomes much more vulnerable to forecasting errors, and that needs to be taken into consideration in the valuation of the firm. And I think overall, a greater appreciation needs to come to the fore in finance theory, and I hope Austrians can bring that to the field of the role of understanding, of prudence, of practical experience, of local knowledge. And that's probably the thing that has been most damaging about modern quantitative finance since its rise out of the Big Bang in 1952 is that the prudence, practical knowledge has been wrongly impugned, and the theorizers, the people who have a mastery of mathematical methods, the people who can write the Black-Scholes formula on a napkin while at lunch, like it's nothing. Those people have been empowered on Wall Street, and I think that has been. Well, there have been some good things about that. I think on the whole, that has been to the detriment of the financial system and its ability to provide financial services to the rest of the economy. So I think what I hope is that Austrian economics will sort of reverse what modern quantitative finance has done in empowering the theoretician and instead giving authority to where it is due to the entrepreneur, to the person of prudence.
My guest today has been George Bragues. George, thank you for being on Economics Detective Radio.
It was a pleasure.
If you enjoyed this episode of Economics Detective Radio, you can head over to economicsdetective.com for additional content and links. The music for this podcast was created by Cassandra McLeod, who you can find at soundcloud.com under the stage name Minaret. That's MINA space RET.